All right, this is a continuation of advanced options. And don't feel like that if you're new to options, you can't understand this because it's advanced. Some of the terminology I'm probably going to breeze by, but, you know, watch it again. That's one thing I say at the beginning of all these. It is recorded. Watch it again so some of this other stuff will sink in. You'll get it second, maybe even third time through. It'll make it much more easy to understand if you're new to options. If you are a veteran of options trading, watch it again because it'll make it sink into your long-term memory. Yeah, you can go online to figure out how to do a ratio spread, but they're not going to give you strike locations and give you specifics about that strategy that you need to have in order to be successful with this strategy. That's what makes it more advanced. Plus, we're going to have a naked put in there, which also makes that a little bit more risky. So this is expanding on our risk parameters going forward. But, you know, I just try to do that, try and, you know, manage whether or not it's difficult to understand versus high risk. And this is easy to understand, but it does carry a little bit more risk, which is why we have it at advanced options. So take that into consideration with your strategy here. HH is talking about something we talked about. And quite the portfolio. Everybody's talking about my daily market commentaries and my earnings trades. I am now long eBay and Facebook, doing covered calls against it. eBay is stock and Facebook is a covered or a synthetic long. Old poor man's covered call is what I've turned it into. All right, so advanced options. This is going to be on the ratio put spreads, okay? We are going to be able to eliminate all risk to the upside with this strategy. And that, if you take nothing else away from this strategy or from this webinar, know that if you are doing this ratio put spread, that you need to at least do it for no outlay of cash or get a credit. Because if you're increasing your risk on a spread, you need to be able to be compensated for it, okay? Make sure that you never do this strategy for a debit. Never, ever, ever do this strategy for a debit, okay? All right, a couple things to go over real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Some of you, may not realize this, but I've been trading for over 25 years. I started trading in college with some money I'd earned. Decided to move to Chicago after graduating with a finance degree and sold all my stocks, bought a badge, and jumped into the pit for the real quick and dirty of it all. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, just about in all market conditions. Go over this disclaimer really quick. Any opinions, news, research, and analysis or other information contained here or information provided by Pro Trader Strategies should be considered general commentary and not constitute investment advice. Basically, what we're trying to do is teach you guys how to swim, not to swim for you. In a sense, I'm trying to give you guys the tools in order to go out and be successful on your own. But please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right. And one other thing, you can follow me on Twitter at Wolfman's blog or follow our parent company at Pro Trader Strat. That cup photo looks photoshopped. No, I did stop short on purpose. I did stop short. All right. So the ratio put spread, it's also known as a 2-by-1 put spread or a front ratio put spread. Okay. The reason why it's a front ratio put spread, I'm not going to even look at the back ratio put spread, you guys, but the front ratio put spread is different because it's a 2-by-1. All right. It means that you are selling 2 and buying 1. The extra put we're selling is to finance this whole spread basically. And that's where our risk comes in. A back ratio spread would be a 1-by-2. That would be where you're selling 1 and buying 2, and you would be doing it for a debit. I'm not going to even mess around with that one. That's a long story, to say the least. If I were you, I'd stay away from the 1-by-2 as well. We're doing the 2-by-1. All right. So the way to build this out is, if you go online, they're going to tell you to buy the at the money and then sell two further out of the money. They're not going to tell you strike locations or any of that stuff. You can easily build this out for a debit. I don't do that because I want to eliminate directional, one direction or the other, whether it's the put or the call ratio spread. So I'm trying to eliminate all risk to the upside with this strategy. All right. So we're buying one. I like to go the one that's just slightly out of the money. You know, you could do it at the money. I usually veer slightly out of the money. And then basically we're selling, you know, the next strike out for all intents and purposes, the next full strike. So if it's like $100 stock, it could be $5 wide. If it's a $50 stock, you're doing, you know, dollar wides, and anything under $50 is like 50 cents wide. Okay. I stay away from stocks under $50 with this for the most part. Okay. I like to use the higher price stocks. It allows you to get a wider spread and a little bit further away. It feels like anyway. Won't that increase your margin? This will increase your margin. Yes. Your margin is going to increase by the short call spread, or the short call, or sorry, off. We're short put. Okay. This extra short put here with the selling too is the one that's going to increase your margin. Otherwise, it's defined risk and it won't do anything. All right. Our market assumption is neutral to slightly bearish. The reason why I do it slightly bearish is because, well, the way we're setting this up, it gives us wiggle room to the downside, and that's really where our max profit is going to be. But we don't care if this market goes completely higher. I mean, if it goes higher, we're fine. But the way to achieve max profit on this would be to be neutral and slightly bearish, okay? But at the end of the day, our risk is to the downside, and there is no risk to the upside. So we're quite happy if it just rallies. All right, and I already did that slide. Is it defined risk since you have the naked put? It is not defined risk because of that extra naked put. Is it IRA friendly? No, this is not IRA friendly. I will show you, Trevor, at the end. Let me show at the end show you how to make this IRA friendly, but it might not decrease your margin. And I would not say that it decreases your risk unless you're worried of a black swan event. Then in that case it would. But if it reaches that defined risk aspect to make it IRA appropriate, you will not be happy if it gets down near that area. All right. All right. A couple essentials to success. Picking the right environment with this strategy, because we're collecting a credit. Whenever we're collecting a credit, we want high implied volatility percent. Now that means high volatility for that particular underlying we're trading. I don't care about the VIX when I'm looking at this. Yes, if the VIX is higher, it will help me out with my implied volatility of all my stocks. Yes, I'm not here to argue that. What I'm here to say is that when we're building this strategy, we're not looking at the VIX to see if this underlying has high implied volatility. We're looking at this underlying to see if its implied volatility is high right now for itself, because every stock has a pretty good range of where it likes to stay for volatility. It has its extremes up and its extremes down, okay? But they will stay within those extremes for the most part. But like a utility stock may have implied volatility of 10, whereas, you know, Facebook's implied volatility is up at around 40 or 50, okay? And that's just implied volatility for the underlying, okay? Tech stocks usually have a higher implied volatility. Usually utilities have really low implied volatility, right? So we want high implied volatility percent. That means high implied volatility for where this underlying usually is. And we want high theta. We want to be able to take advantage of theta decay because we're collecting a credit, because we've got that extra short put in there. We need to make sure that we get that theta decay. We want all of this volatility and theta to come out of this strategy in order for us to be successful quicker. All right. Picking the right underlying. This has to go back to, you know, tight bid ask. Now, sometimes on earnings, I go a little bit wider than all my rules, but that was for some of these stocks that we're jumping around. But let's just look at XOM for the most part. If we're looking for picking the right underlying, we want to go to the main monthlies, which is the spot monthly, which is the closest to expiration, and that's going to be this one for the most part. You know, if it gets down within 5-7 days, that's usually not the spot month anymore. You roll out. But what we're looking here is any stock under $100, we want the bid ask to be 10 cents wide or tighter. And this fits the rule pretty much across the board, okay? So XOM, under $100, 10 cents wide. Any stock under $100, our bid ask should be 10 cents wide. If it's over $100 and we go to it, then we just basically take the decimal, move it 3 ticks to the left, 1, 2, 3, and NVIDIA should be 25 cents wide to the bid ask. And you can see that it works 25 cents wide to the bid ask. It's inside of that. So that would fit this rule as a good stock to trade, if, you know, for options. There's a lot of stocks out there that have, you know, a lot of volume. You know, Aon may have had 8,000 contracts or 8 million contracts traded today, but their bid asks on a stock that's similarly priced is going to be super wide. So stay away from those, especially if you're just getting into options trading. Stay with these tight bid asks. The market's shown you where value is. If it's 50 cents wide, you guys, you don't really know where value is. There's one guy in there making the offer probably, you know, 10 cents higher than he's willing to sell it, and the bid, you know, 10, 15 cents lower than where he's willing to buy it, because he knows he's the only cat in town, so he can make price whatever he wants. And you guys have to come to him in order to get filled. So keep that in mind. Stay away from those really wide ones. All right. Hey, Ted, good to see you. All right. Does that make sense for everybody? Tight bid ask, easy enough. Under $100 is 10 cents wide. Over $100, just move the decimal place 3 cents, 3 decimals. That's how wide it should be in the option montage. And if you ever hear me say option montage, that means that whole area where all of the stocks options are located. This whole thing is the option montage, all the way through, all the way down to the furthest options out, okay? So that's the option montage. And the right duration, again, we want theta decay volatility. So what happens if we want theta decay? Where do we want to locate ourselves if we want theta decay maximized? Inside of 45 days. That's right, Jesse. Inside of 45 days. That's where we start seeing the most theta decay. 35 days is usually where I say it, but inside of 45 days for sure. And whatever's closest to 35 days is usually where I land. So right now we're kind of right in between those two spots, right? What do we pick? You know, we got 22 days to expiration or 57 days to expiration. What's closest to 35 days? Or even, you could even say 40 days. It's pretty much a pick 'em. I'm probably going to lean towards the nearer duration. Inside of 20 days, I'm probably going to roll it back out to the further one, okay? But we're still pretty close to 35 days. And especially if you have a lot of volatility, high volatility, that I would lean towards the inner area, especially if it was really high implied volatility. I'd probably go closer to expiration, because when that volatility comes out, all of the theta comes out all at once, and you can get in and out of these spreads quicker when you're collecting a credit. Okay, so we're looking for this theta decay, this all coming out. And what happens when we have volatility involved? Volatility has an effect on this curve, and it makes the premiums kind of feel like they're doing this, and it kind of holds off theta decay because volatility is pumping it up. And then when everything comes out, then it kind of catches up, all right, to where it should be. So we kind of want to get it in an area where it's inflated, overinflated. And that's where we're going to get our volatility when it comes out. That's money, equal to money, okay? So we want to try and get inside of 45 days for sure. 35 days is the real sweet spot. I like to get usually outside that a little bit, but I think way out here at 50 days is a little too far for me. I'd rather get in here with some high volatility and get that theta decay coming out of it real quick. Good. Yeah, Banu, I'll read that in a second. Give me a second. Wait till we pull up the platform and I'll talk about that. Picking the right strikes. Okay. This is really important. Like I said, you can go online and figure out how to do this spread. I'm not going to lie. They're going to tell you, you buy one strike and then you go further away from the market and sell two. Okay. That's it. You're done. Go, be free. You're on your own. Webinar is really short today. No, that is not going to help you, you guys. That is going to put you guys at more risk if you just go out there and willy-nilly do this and not follow these rules. Picking the right strikes. We have to do this for no outlay of cash or at least a credit, okay? I prefer a credit. I'm trying to search high and low for any kind of credit because then if it goes straight up, I get to keep that credit. If it comes down a little bit and nails my number, then it's going to kind of be like a butterfly in a sense, where it's a really broken off. It's a one-winged butterfly in a sense. That's where you get your max profit, okay, is when it comes down just where your pinnacle is. And when I pull up the platform, you guys, a lot of this stuff will come through. I just want to get, did anybody else lose sound? Anybody else? Everybody hear sound? My monitor is saying I can hear it. Since nobody's responding. Okay, a lot of people are saying, if you ever have that situation where all of a sudden something happens, it's usually not me, it's GoToWebinar. If you log off and log back in, that usually will help stave off that situation, okay? All right, picking the right strikes, you guys. We need to do this for a credit. So that's why I like to go a little bit just out of the money and then sell the next strike out, all right? And again, we'll do that. It's usually going to be one option strike further out of the money is usually where this lands. All right, picking or knowing our exit strategy. All this stuff, you guys, when you go through this, especially when you're first learning to trade like I do, write down why you got into this, what your assumption was, what the volatility, write all of these details down on a piece of paper and stick to it. If you write it down, you're going to be more likely to follow through with the way you set it up. You know, one thing you could do to increase your success rate is setting these strategies up at inception with a high probability of success. And if you set this one up wrong, it is going to increase your risk and decrease your probabilities of success, okay? I'm trying to make it where we can increase our probabilities of success, and that by adding more risk to one side and eliminating the risk to the other side, that has increased our probabilities of success dramatically, okay? All right, so our max profit is the long strike, that long put minus the short put plus the net credit. So our max profit is the width of the spread. Even though we got that extra short put in there, it's the width of the spread plus our credit. So if it's a $5 wide spread, it's $5 plus the credit we received. All right. If you don't get a credit, then it's plus zero. If you get a debit, don't do it. Move on to a different option strategy with high, that can take advantage of high implied volatility and your market assumption. All right. You said IV of the stock very high. You go with shorter durations, right, for the theta decay. Yes, for high implied volatility percent for and when I mean implied volatility, I mean the implied volatility percent. So let me just go over this real quick to make sure we're all clear concept before we move on. All right, so right now we can see NVIDIA has 43 IV percent, okay? Right now it's IV, its implied volatility is 39 point something, right? Or this is in decimal place. When you do a percent, you just move it twice, right? So 39% right now, NVIDIA. So to come up with implied volatility percent or whatever I have over here, if you have the option montage on TD Ameritrade, they give it to you right there. It's rounded though over here. We take 40 or 39 in the numerator. We take two sums and divide them by each other, right? So in the numerator, which is on the top of the fraction. We take 39, subtract the bottom, which is, let's say it's 17. So in the numerator, we have 12. So 12 divided by then the high minus the low, which is 60 minus 17, so 50. So that doesn't seem right. Did I do that wrong? 20. Sorry, my math is off. 21. So 50 or 21 divided by 50. Yes, 21. Everybody's blowing me up. Everybody, 22, not 12. Yeah, sorry, 22 divided by 50 puts you somewhere around 44, right? So you take where it currently is minus the low, take that sum and divide it by the high minus the low. That's how you come up with an implied volatility percent. So this tells me it's right about where it normally is. But you can see with stocks and implied volatility, they get to highs and they get to lows, and then they kind of start snapping back and forth, right? You know, right here is a pick'em. I don't know which way it's going to go. So I would stay away from this one. It's too close to that 50. This, I want implied volatility percent to be above 50, okay, because I'm collecting a credit. So I want it in this upper half so that it wants to come back down to normal. And when it's at an extreme low, then that's when I want to buy it. It doesn't mean that when it's at 0%, it's not going to go any lower, because it is a very simple fraction. You know, if this went from a low of 17 to a low of 16, that low of 16 is still 0. And it goes down to 15. That low is still 0 because it's still coming into the equation, but it's still 0. Same if it goes above this 69 and goes to 70, that's still 100%. Okay? So keep in mind, all it's telling you is that when it's at an extreme, it's really overdone and wants to come back down, right? Just like any other type of chart. That's the nature of the beast, all right? All right, our max loss is that short strike minus the max profit, which is the width of the strikes, to 0. Okay, that's our max loss. So $5 wide spread, you know what I mean? And then our break even is the short strike minus the width of the spread. So if we have a $5, if our short strike was the 95 puts, and we had a $5, it was 195 put spread, right? It would be the 95 puts minus $5 for that width of the spread, minus the max profit, whatever that is, all right? Because the width of that spread, that initial spread that we originally have, the long put spread without the extra put, we make up that money. We get to keep that $5 in distance. But after that $5, we start losing because of the extra short put, all right? But if we were to nail there right at the short strike, then that's ultimately where our max profit is, or our max profit will lie. And I'll show you that when we pull up the Analyze tab here. I'm going to go through all of this stuff as soon as we pull it up. So this is the part where I throw it out to you guys to give me some stocks. I don't like doing this ahead of earnings, okay? So assuming there's no earnings in here, we want high implied volatility. And of course, the ones that are way up here with high implied volatility have a lot of earnings in them. We could look at Facebook. It just came out with earnings. Usually with earnings, we will see this kind of volatility crush come out of after the binary event. But look what happened with Facebook, and I have a position in it. So keep that in mind. I'll just type it in. Facebook's implied volatility went up after today's earnings. Usually you can see, boom, they get struck out. So usually when there's high implied volatility, it comes out. This didn't happen because of the major drop. Now, I'm not necessarily saying I love Facebook. I got into this trade, so I'm trying to be mechanical. I am going to have a very short leash on this. If tomorrow we break below this support level right here, or this level here, I'm going to be out of this trade, okay? I'm basing this off of this spinning top doji, or whatever you want to call it, hammer, or whatever. I don't know. I don't remember all the names. I just know that that is a very strong signal of a bottom right there. So I'm going to go with that. If we confirm to the upside, I'm going to be happy. If it breaks below this, I'm going to pull the ripcord on my Facebook trade. But Facebook, you know, Facebook 33 minus the 33 minus 13. Oh, they're making math easy for me today. 20 divided by the high minus the low, 46 minus 13, so 30. So that's up in the 60s. Oh, yeah, it's up in the 60s. Cheap. 64.43. Pulled that out of my hat. All right, so this is where I sold the call against my synthetic long stock to try and make that. I actually did really good on this earlier this morning. I sold it, I think, at $1.70 or something. All right, so we're going to be looking at this closest to the market, 76. So this one's the at the money. It's probably the at the money right here at 75. You know, so we can look at both of them. So you buy one of those, and then we're going to sell two of these. All right, and that's how we do it. So we're getting a credit, $1.25 credit. So now let me break this down to a one lot, 1 by 2, so you guys can see it on the Analyze tab easier. 1 by 2, and then now let's look at this on the Analyze the trade. So you can see this, all the stock positions. So to the upside, we get to keep that $1.25 to the upside. To the downside, though, you can see that risk is eternal. To the downside, so we are trading right around here right now. So you can see that when I said we are neutral, because we would like to stay right here or maybe even go higher, to bearish, because to bearish means we get to down here to get to our max profit. So our max profit is right there when we land on the two short strikes at 170. That's our $5 plus the extra credit. That's why it's going above $500. That's the extra $1.25 in there. And then we get all the way down. Our break even is going to be at like 63 something, 63.74. Yeah, 63.75 actually, right? Because the $5 wide spread plus the extra $1.25 we received puts us at 63.75. Okay. Does that make sense? So as we're going down, we start increasing because we're getting closer to that 170. We get to the 170. If we pinned right there, that would be our max profit because we'd get to keep the credit. Our two short calls would decay worthless. Our two short puts decay worthless. Our long put gets that $5 in value, increases $5 in value. And we got to keep that $1.25 credit that we originally started out with. All right. So that's the way you figure out that break even. And then when we start going higher, think about that. Those calls are starting to gain in value, but those puts are, that one put is also, it's only offsetting one of the calls though. And then we get here and it starts getting worse. Okay. Any rule about how much you'd want to collect for the width of the spreads? No, JQ, I don't have a rule on that. The rule is just try and collect anything. The more, the closer to at the money, the more money you're going to be able to collect. Okay. Because think about it, that's more risk, right? More risk of loss. So more risk entitles you to receive more money. The further away from the market you get, which we'll see here in just a second, by doing this, we'll do this one. You will see I'm not going to likely get as much of a credit. So I want to buy one of these, sell two of those, and I'm only going to get a $46 credit. But I've, gotten my break even further out. Now, one thing to note about this is where's Delta? The one thing I want you to know about this spread, the beauty in this is this spread, although we are very close to the market on this, because of the spread and the way that this strategy works out, it gets us to one standard deviation, okay? Which, that's where our loss starts. All of the credits and everything else put together on the Analyze puts us very close to a one standard deviation move. So let me get rid of this stuff. Go back to this one. So as you can see, to the downside, this is one standard deviation. It's very close on our break even to one standard deviation. This one's a little bit further off. It's going to probably be like a 18 or 20 delta or something like that. 16 delta is the one standard deviation move. But so we can look at this here. So from 170 to 65, right? We got that $5. Now another $5 down is where our break even was, right? We saw that on the Analyze tab. It's right around 160-ish on this one because we got the $5 plus the credit. So it's going to be 159.54, right? That's our break even. 159.54 should be. So that, let's just call it 160. 160 strike is a 13 delta, which is a 13 probability of success, and one standard deviation move is a 16 delta, right? I've gone over, if you guys are new to options trading and I just blew your minds away, that's one of those nuances that I've talked about, probably till some of these other guys are blue in the face and are sick of hearing it, about the one standard deviation stuff. So go back and watch a couple of my earlier ones. You'll figure out the one standard deviation move. It just has to do with a bell curve. And we want to either be an A student or an F student, okay? Because we want to be at the extremes most of the time. But this option selling strategy gets us to a one standard deviation move to the downside before we are really wrong, right? We haven't lost money. If we're not losing money, I'm saying I'm not wrong. Because the way I build my strategies, I like to be able to be wrong and still be right. If you guys watch my earnings trades, I don't know if I've had a market assumption that was right yet, and I've made money on the majority of them. I've had a couple of them go against me that I've had to be mechanical with, that you'll get to hear me talk about for the next couple months if you watch the daily market commentaries. But that's the beauty in this spread, right? With a regular put spread, we have to be right. We have to have it go down to make money. This one, I don't have to worry about a whole lot. I've got basically an 84% probability of success when setting this strategy up, because I only have a 16% probability of losing. Those are pretty good odds, right? If I said I'll give you $50 and you have an I'll give you $50 and you have an 84% probability of being right, wouldn't you do it? Yeah, I would. So stick with that. To get out, one thing I kind of rushed through on that with the know your exit strategy, writing down your stuff. The exit strategy for this, I would be getting out at 50% of my max profit. What's my max profit? The width of the spread plus the credit. So on this one, I'd be getting out at $2.75, right? $5 wide, $2.50 plus half of that, 25 cents, $2.75. Write that down. I put it on my piece of paper right there next to my strategy. Okay? And if it rallies, then I'm just going to let this decay worthless. I'm going to keep the whole 46 cents. Has everybody got it? Any questions so far? All right, I saw somebody throw out GM. Now, this is what I'm talking about. I think it was John or JQ or somebody threw this out. With GM, it's below a $50 stock. It does make it very difficult to do this strategy, but if you're pretty bullish, or market neutral. Really, with this one, you're going to need to be pretty market neutral, which isn't a bad spot to be in for me, as far as I'm concerned, because it's very close to the point of control. That's probably where it might migrate to. So I might do something like that. You can throw up your Fibonacci's. I got it on the extension. Sorry. Or let's go back to the Fibonacci and I'm going to do this dirty. I'm not going to line it up very good. I'm just going to kind of slap it on there. So especially if it would have settled above there, but you can play around with these different things in order to try to be successful with this strategy. All right. So GM, we've got our lines in the sand. We'd love it to go to 36, 38 and just die there. So you could go closer to at the money on this one. It's 36.75. So maybe even slightly in the money, but I'm telling you probably only $1 wide to get a credit. Yeah. 6-cent credit. All right. So if it rallies up, we get to get that 6 cents. If it stays right here, just slightly goes down a little bit, we'll be very happy. Goes down, 50 cents at expiration next 20 some days. That would be great. Okay. So it gives you wiggle room to the downside. And on this one, we can do this again, dollar wide. So a dollar wide to our break even is 35 plus 3 cents. So 35, let's call it. And just inside of one standard deviation move. Now, keep in mind, remember when I was talking about high implied volatility percent needed for this strategy, that also comes into play that you can get further out with this strategy and get to that one standard deviation. We only have a 30 some odd, 34 implied volatility percent, which means we're not getting paid for volatility here. Volatility is too low. So it's making us stay tight to this market. All right. All right. A couple of questions I saw coming up real quick. You said, I think I answered the IV question, right, John? Any rule about how much you want to collect? I answered that one. 20 days left. Would you roll out? If I was losing on this, and it was maybe right at my shorts or right at my break even to roll this out, yeah, I would roll this out because I'm collecting a credit. If it was a debit spread, no, I wouldn't roll it out. Okay, but because I'm collecting a credit and I can probably collect another credit by rolling it out and increase my break even to the downside. Anytime you're collecting more credits, you're increasing your break evens, right? Or getting your break evens further away from where the underlying is or where you initiated this. So yes, I don't have any problem with that. If your market assumption is still the same. If your market assumption changes, like you're a little worried about it, then I have no problem pulling the ripcord on this strategy and getting out of it, you guys. Think about it. The probabilities beat you on one of them. Then you just walk away. And the next time, the probabilities are even further in your favor, right? How do you defend it? How do you defend it if the price heads quickly towards your short strikes? Well, if it goes straight to my short strikes, I'm going to be pretty cool and calm and collected. When it goes to my break even, that's where you start needing to make a game time decision, right? If it gets down there, how close are we to expiration? Does it look like it's going to continue in that direction? If you think it's going to continue in that direction, get out, right? If you think that it's, all right, now it's overdone, it looks like it's turning around, then I would stay in it, But back to Banu's question about rolling, I would probably do that about 7 days to expiration if that's where I was going to do my roll. That makes sense, Dan? Oh, Trevor was asking, how do you make this IRA appropriate? All right, so to make this IRA appropriate, you basically create a broken wing butterfly. Because remember I mentioned we broke off the wing here. And a broken wing butterfly usually is, in this case, would be the 37, 36. We skip the 35 and go to the 34, right? Well, that's the broken wing. Well, for the IRA, all I'm concerned about is just defining this risk the same as most of my other strategies that I'm doing this in an IRA. Buy it for the one that you could get for, a nickel, which is probably going to be this one here. So I'd go out and just buy that one. That makes it IRA appropriate. You see it all of a sudden turns from a back ratio spread into or what it said was a back ratio spread to a butterfly here. It's actually a broken wing butterfly, right, is what we talked about in those other webinars. When I talk about a broken wing butterfly, though, I am specifically looking for skipping one strike and then that embedded spread pays for it, okay? That makes sense for everybody? And like I said, they said when I didn't have this strike in here, it was a back ratio spread. That's incorrect, right? It's not a back ratio spread. It is a front ratio spread. Oops, let me just do this again. Buy one, sell two. Why is everything jumping? Buy one, sell two. See, it says back ratio. It is a front ratio spread. Remember, the back ratio spread was the 1 by 2. This is the 2 by 1 because it's selling 2, buying 1, right? So it is a front ratio spread. They wrote it down. The other one's not really a broken wing butterfly, but it is. They're just doing it to make life easy for them. But I am right. They're wrong. And I'm sticking to it. All right. So you get to collect that credit, but GM is too tight, not enough implied volatility. I'd walk away, find a different strategy. All right. Another one was somebody threw out GLD. GLD's had a big sell off and may have found a bottom here. Let's just look at the charts. This bottom here, which is, the 61 fib. If you guys trade off of fibs, you guys know that this is a major buying area on a sell-off. It goes through the 50, the 60, early guys get out at the 38. Some people wait for the 50, and really aggressive traders that have a lot of intestinal fortitude will wait for the 61 to get out of their shorts or to buy, okay, or to find that support. So in that regard, I think, hey, gold may have found a bottom here. It bounced off. It's kind of supported there. I think it's overdone. Everybody's interested in the dollar right now. Gold's just kind of lost its luster for a minute. So in that regard, let's look at gold. Closest is 15, 16. We can go. Let's just go a little further out. It's $100 strike, so I'm probably going to be able to go at least $2 wide. Hopefully, no, I'm not going to. See if I sell these. It's only going to be. I'm going to be doing it for a debit. So do the 115. Oh, it's not an implied volatility percent of 50. You're right. ETFs, my rule, you guys. Stocks selling premium above 50, ETFs is above 30. That's something I've mentioned a ton of times. But for some of you guys that are newer to this, my webinars, when I do ETFs, my line in the sand for an ETF is 30. My line in the sand for a stock is 50. All right. You're selling above 50. You're buying below 50. And for ETFs, you're selling above 30 and buying below 30. Okay. Front ratio spread is buy one, sell two for a credit. Back ratio spread is sell one, buy two for a debit. John is on the ball. John gets a cookie. Yes, that is exactly right. So you can play around with these, but it's not looking. You can probably go down to these 14s. This will work. So we have to go a little bit further down. We could do the 70s and we could do the 115s. We can only go $1 wide here. And most of that has to do with the fact that we have low implied volatility, all right? But it's high for itself. So there and there, we're getting, but we're buying one, selling two, and we get a small credit. Dollar wide, so our break even is at 112.86, right? Because of $1 wide gets us to 13 plus the credit. Can you repeat the IV rule for an ETF? Yeah, I'll do it for both of them. For a stock, all right, an individual stock, the implied volatility percent needs to be above 50, all right, because that's high for itself. Now with an ETF, it struggles to get really high. It may spike every once in a while when there's a big sector rotation or something like that. Okay, that's when ETFs really spike. And then, that's why it puts that, out of whack, because it goes out of whack for a short period of time. But for the most part, ETFs, some stocks will have really high implied volatility and some will have low at any given time, and they all meld each other out. So for an ETF, selling premium above 30, buying premium below 30, okay? Stock is above 50, below 50, right? Does that make sense for everybody why an ETF is different? Thank you, Amaro. Appreciate the kind words. Thank you very much. All right. Did I answer that for you guys? John, you with me? Front ratio spread versus the long. The thing is, if you don't really love a butterfly, this is going to be very similar to like the butterfly, because with the butterfly, the idea is to nail that number. That's where you get your most bang for your buck. There's two short strikes is where you get it. That's the same thing with this one. But the beauty in this is if it goes straight up, we still get to keep a credit. Okay. Front ratio spread does not equal a butterfly. No. It's similar to it. It's just similar to it. You know, when I did that, you know, if I went out to the 13 strike to buy, then that would be your butterfly, right? A broken wing butterfly, the way I write the rules is then 12 would be my broken wing butterfly, all right? And if I just wanted to do a put ratio spread, then in an IRA, then I would just go out and buy the first one for a nickel. That creates a broken, you know, quote unquote, broken wing butterfly, but that quote unquote broken wing butterfly does not fit my rules. But it makes it IRA appropriate. I look at it as it's synthetic. We've created a synthetic ratio spread, or you see me do it in daily market commentaries. I'm doing it as a synthetic naked short put for earnings. Okay, I do the same thing, right? For stocks, we want to sell premium when ID percent is above 50. And when we're buying options, we want to buy options when they're below stock options when they're below 50. Because our idea is when it's really low, it's going to increase, and we can increase our probabilities of success because as volatility goes up, it holds off theta decay. So it gives us a little bit more opportunity to be right. That's how I've been wrong in my earnings trades, is I've been selling premium directionally wrong, but I've made money because of the volatility coming out. And that's how we try and play that. That increased my success, which is beautiful. All right. So that's about it. I've mentioned a bunch of times, you guys, daily market commentaries. You don't get it with a lot of different offers, but this one we have it included in there. You get my daily market commentaries. You can watch me spout off about earnings and geopolitical stuff, all the economic data points. I tell you how that's affecting the economy, global economic data points as well. I'm talking about Europe all the time. All of those things are covered in the daily market commentaries. Those are super valuable, I believe, anyway. You know, and if it's not, please let me know. You know, at the bottom, give me a comment. Let me know, or write to me at Pro Trader Strategies. Oh, this link is in the chat window. I'll send it in right now. Should have gone out to all you guys. Just link on the chat window. We are going back and forth in the questions box, but that chat window should have it. John got it. Good. Cool. Also, you get access to the archives. There is hundreds of videos in the archives. All right. Also, you get priority access to the trading workshops, which is like these webinars and stuff like that. We've been selling out, so you guys can take advantage of that getting in on some of them. All right. So all for $7. All right. First month for $7, you get all of this stuff. Hours of even short videos where I've done like 10, 15 minutes. So you don't have to watch a full webinar again to remember what all my rules are for each individual trading strategy. You know, you just go in there, watch a real quick one. Okay, yeah, got it. Move on. All right. So you can take advantage of those as well. All of that stuff for $7 is a deal. I mean, you guys owe it to yourself for $7 to take advantage of that, just to get the daily market commentary, see what I'm doing in earnings right now. You guys want to see me scramble and be mechanical all day long? Earnings is the time to take advantage of that. All right. So later webinars, I'm going to be drilling down on different option components, how I trade, especially in the daily market commentaries and trades when and where I find them appropriate. Daily market commentaries, that's all over that. Here's the link. If you're watching this on tape delay, you're going to have to pause it, punch it into your URL. It's not a hot link or anything. And finally, I just want to thank you guys all. If you want to reach out, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. Let me know, you guys. If you guys want a strategy I haven't covered, reach out to me. Also, if you have any comments, need any advice or anything, reach out to me. Oh, one other thing I forgot to mention with this is you get free access to me. With premium membership, you get access to me. You can write me, hey, Wolfman, this strategy is going against me. How would you be mechanical? I will get back to you. I have a no inbox policy, which means if you reach out to me, I'm going to get back to you. And if I can't do it in an email, which I hate typing, I will call you or we'll set up a phone call, because I know that when you are feeling like you're twisting in the wind, you can't wait for somebody to, give you a lift. All right. And that's what I'm going to try and do, is make sure I take advantage, get you guys on that really quick. All right. Eric, this is the best $97 I ever spent. Thanks, Ted. I appreciate that. Have a nice day, Ram. Appreciate it. John's taking off. Cool. Appreciate it. Do you still sell calendar spreads before earnings? I do. Before earnings, like well in advance. So if I was going to do a calendar spread, I would do it for the earnings that just happened, like Facebook or, what was it the other day? Some of the bank stocks, Morgan Stanley, Goldman Sachs, setting up for the next earnings, because that's where I expect volatility to expand. Thanks, Andrew. Appreciate it. All right, guys, go ahead and click on that link. That's all I got for you guys. If you can't take that, take it easy. Take care, buddy.